Students, for today's video lecture, I will be covering problem number 2 of set off and carry forward of losses. So problem 2 deals with income of Mr. C for previous year 24-25, and brought forward losses information is also given. We need to calculate what is the capital gain. So this problem deals with capital gain uh, calculation in the hands of Mr. C for assessment year 25-26. Now, before going ahead with solving this problem, you have to understand the basic rule of set off and carry forward of when it comes to capital gain. So whenever capital gain is there, please remember a long term capital loss can be set off against long term capital gain only. This point is very, very important. But whenever there is short term capital loss, this can be set off against long term capital gain or short term capital gain also. Okay, that is short term and long term. So again, I will just highlight this. Long term capital loss can be set off against only long term capital gain, and short term capital loss can be set off against long term capital gain or short term capital gain, both. So now we will discuss this problem. Particularly here, information is given as first short term capital gain, which is 1,50,000 for current year, and for current year we have been given long term capital gain of 75,000, and we have carry forward of capital losses. First one, we have long term capital loss of 25-24, that is 96,000, and we have short term capital loss for 24-25, that is 23-24, 37,000. Now first we will take short term capital gain of 1,50,000. So please remember, short term capital gain is there. So we have short term capital loss and long term capital loss. So long term capital loss can be set off against long term capital gain only, and short term we can go for short term capital loss, capital gain, or long term capital gain. Okay, so now this 96,000 we can set off with long term capital gain, which is 37,000. So these two we can set off, that is 75,000, 96 minus 75,000, and short term capital gain we can set off with 37,000 of short term capital loss. Okay, so this is the basic rule which we need to understand. If we see calculation of capital gain of Mr. C for assessment year 25-26, first one is short term capital gain of 1,50,000, and we have brought forward short term capital loss of 37,000, which can be set off, and this has been carried forward from previous year. So we have 1,13,000, which is taxable as short term capital gain on sale of share. Next, we have long term capital gain of 75,000. We can set off this with brought forward losses of long term capital loss of 96,000. Out of 96,000, we can utilize 75,000, and remaining 21,000, we can carry forward this long term capital loss. So this is nil. So taxable short term capital gain is 1,13,000. So in this problem, we have to clearly remember that we have long term capital loss of 21,000. So now the question will arise, why we cannot set off this with 1,13,000. So very important rule is, whenever there is long term capital loss, we can set off that with long term capital gain only, and not with short term capital gain. That is the reason this 21,000 is not been set off with short term capital gain. This is the node which is provided here, that long-term capital loss cannot be set off against short-term capital gain. Hence, the unadjusted long-term capital loss, that is 21,000, can be carried forward to next year to be set off against long-term capital gain of that year. So this was the solution to problem number 2. Thank you, students.